Hello, everyone. Welcome to TSAM Daily. We've got Peter Kraus joining us today. He's the chairman and CEO of Aperture Investors. Let's go have a chat with him.
We are a new asset management company focused on creating investment services where the fee structure is set so that we charge only if we outperform our benchmark. We have a modest base fee. We think that's a better way to align the incentives of performance with the client objectives, which is also to get performance. That's the structure of the firm, and every manager is set up that way. I have been in the industry for over 40 years, managed a number of other companies, and I'm having a good time in a very tough market, but we're doing okay.
Good to know. Thank you very much for the intro. Talking about how markets are performing, what do you think the short-term and long-term effects of COVID-19 would be on the investment management industry?
Well, I think the actual effects of the disease on the industry, I think the disease itself, I don't think has an effect on the industry per se. But I think the possibility of a disease like COVID-19 will have an effect on how the industry supports itself in terms of contingency planning. I think it's been pretty obvious to everybody in the industry that having a remote location that everybody went to in the event that your main location went down or had some kind of physical problem, that's not going to be very valuable because if you have to work from home, having a remote location is irrelevant.
Yeah.
So I think that we're going to see the industry essentially find ways to build systems that are ultimately work from home structures. And that'll be the contingency planning in the future. We'll see companies develop that will, like Zoom, for example, that will create more and more robust systems that allow people to work from home. I think that probably will help the industry in the sense that, investment managers can operate from remote locations. They don't need to be in an office. And that may, you may find that decentralized structure lowers the cost structure of the industry and, helps at a time when, costs are challenged or the industry is challenged by its cost structure. So I think that's a possibility. But look, at the end of the day, people are social animals, and they aren't going to want to stay all by themselves. Even the most introverted portfolio manager that you've ever found, every once in a while wants to see a human. So I guess I've seen some that they'd probably prefer not to, but for the most part, I think that they all want to interact in some way. So I don't think offices are a thing of the past. I don't think, we're going to see some dramatic reduction in office utilization in the industry. But I do think that the contingency planning will change. And I do think that, people will be more flexible in their work environment, which may on the margin reduce the amount of space that you need in an office on an ongoing basis.
Mm-hmm, mm-hmm. And do you think the way investors interact with their clients and asset managers interact with their clients, would that change at all? Would they be more open to having a Zoom meeting just like this rather than meeting face to face and asking their investors to fly over and visit them?
Yeah. Well, I'm of two minds on that. Of course, at Aperture, we're actually quite focused on delivering content over the internet. And we've been, I think, pioneering doing that in very frequent installations. So people have used the internet before, for sure. But on a weekly basis, portfolio managers are providing 90-second to 2-minute videos regularly to potential clients or using LinkedIn, Twitter, Instagram, and Facebook. So I'd say we're sort of at the forefront of leveraging that, and we were doing that obviously well before COVID-19. I do think that people are learning that they can communicate pretty effectively over this vehicle, and there's no reason therefore not to use it. And look, I mean, to fly 8 hours to someplace, have a meeting, and get on a plane and fly 8 hours back, that's pretty inefficient. On the other hand, people, when you're dealing with money and you're dealing with your money, there is I want to see you, I want to touch and feel the person.
Yeah.
So I think that, again, on the margin, I think some of these meetings can be done in the way that we're doing this. But at the end of the day, I also think people want to be together. I think you're still going to have sales meetings. I think you're still going to have conferences. I still think, you can have a Zoom meeting. That's great. But, if you and I wanted to have a cup of coffee afterwards, we can't do that. We could say, fine, I'll call you afterwards and have another phone conversation. But look, the essence of humans they are energized by being around each other. And I don't think that's going away. And
True.
so, this is a effective adjunct, and it's going to educate a lot of people that they can use this vehicle effectively. And on that basis, again, on the margin, I think people will say, yeah, let's do a Zoom call. And you might communicate more effectively. And by the way, one of the good things about Zoom is that you might stop using email and Slack. We had a town hall yesterday with our firm, and we said, look, if you find yourself writing a lengthy email, stop and get on Zoom. Or, we use Google Hangout. Get on Google Hangout and talk to each other face to face, because it's crazy. What are you writing a long email for? And you need to see people, and you need to talk. You can see them smile. You can see them frown. You can see them wink. You can see them move. You need those physical clues to be able to communicate effectively. So yes, I think this mechanism is useful, and I think it will enhance communication, but I don't think it's going to substitute. It's going to be the substitute, the permanent substitute for human interaction.
Mm-hmm, mm-hmm. Perfect. My next question would be, how do you think the US and European markets, they would recover from all of this compared to the Asian markets?
The actual financial markets, or the market in general, do you mean?
The actual financial market.
Well, I actually think the Asian markets have stabilized. I wouldn't say they've recovered, but they have stabilized. The Chinese market actually is not down as much as the U.S. and European markets, mm-hmm. which might bode well for those markets recovering more rapidly and it certainly has been that way for the last week of trading. But I think these markets are also pretty interconnected, and at the end of the day, they're not going to be all that independent of each other. I think this is a global pandemic. This is having a global effect on all the markets. The liquidity that's being injected into each of the markets is benefiting each of the other markets. Mm-hmm. When the PBOC in China injects liquidity into the Chinese banking system, that has a positive effect on obviously the Chinese banking system, but it also makes the rest of the world feel like, okay, there's a stimulus going on in China. And when the Fed does that in the United States, it has a similar effect, sometimes even a larger effect. And the same for the ECB. And so we have seen coordinated central bank action and now coordinated fiscal action since 2008. The central banks and fiscal stimulus, to a lesser degree, have been correlated around the world in these crises in a way that's been supportive of all the markets and has had an effect on all the markets. So unless COVID-19 were to have an outsized effect on one economy versus another, which I don't think is the case. Mm-hmm. For example, in the United States, the S&P is comprised obviously of 500 companies. The amount of revenue or earnings of those companies that come from outside the United States today is dramatically more than it was 20 or 30 years ago. And so, although those companies trade in the US, they reflect global activity. And so, that's why these markets are much more integrated than they might appear to be. So I don't think that you're going to see a different effect of COVID-19 on Europe than you will on the United States. There are going to be degrees of difference for sure, but I think in large magnitude differences, I don't think you're going to see one market's not going to go up and another market's going to go down.
Mm-hmm. All right. And talking about moving on towards portfolios, how are active portfolios performing against passive portfolios in this climate? And going forward, do you think that this will change investor mentality at all?
Yeah, that's a really good question. Active management has been saying for 20 years, we will have our time. Passive will underperform. Passive will be in the fourth quartile. That hasn't happened for 20 years. It may not happen now. I don't know whether it will or it won't. It's not, by definition, because you have a market decline, that passive will underperform. We've seen market declines before. That hasn't been the case.
Mm-hmm.
So there's no reason to believe that because you have a market decline now, that it's going to be the case in this situation. So I think we actually don't know the answer to that. But this is the key point to me. The key point to me is when you have these crises, and in particular, this particular crisis, the differentiation between company A and company B grows dramatically. Passive doesn't pay attention to that. Passive, it's irrelevant to passive. Active managers can actually take advantage of that. And when those differences are bigger, it stands to reason that active management should be able to outperform. Now, will all active management outperform? No. Mm-hmm. Will the average be better? Maybe. But the bell curve or the distribution of good and bad managers, I think probably extends. In other words, the tails get wider. And hopefully the right tail, i.e. the better tail, gets fatter because you have more opportunity to outperform. There's more opportunity to find a company that's going to be significantly made better by COVID-19. And a company is going to be made significantly worse by COVID-19. And I think that analysis, that process that happens in human interaction and human analysis, that's a key issue in this cycle that active managers can take advantage of. Quant managers are going to struggle because it's going to be hard for the quant manager to get enough data that will suggest differentiation of the company. Because what you're looking at right now is that, well, a company's going to have dramatically lower sales and dramatically lower earnings for a period of time, maybe 1 month, 2 months, 5 months, we don't know. It's going to have to increase debt on its balance sheet. So as the debt goes up on the balance sheet and the flexibility of the company begins to decline, you're projecting what that company's going to do in a year's time and how quickly it's going to be able to get back to its earnings. That's a hard thing for a quant analysis to do because it's looking at back data. It's not looking at forward data. It's not taking forecasts in that way. It does use forecasts in some cases, but it's not doing that kind of analysis. Only the human is doing that kind of analysis. And that's where I think the differentiation is. So there's a good case now that some active managers will materially outperform the indices. I don't want to make the case that in tough markets that active always outperform because I know that's not true.
Yeah. And do you think going forward, people will look at hybrid portfolios in more detail? Because a few of the speakers have been talking to me about how they are looking into creating hybrid portfolios with a little element of passive, a little element of active. Do you think the industry will take that up more quickly now?
Well, I believe that is how portfolios need to be constructed in the future. So the basic problem in the active industry is there's too much money managed actively. You can't earn a return on that much money. And that's the reason why, amongst other reasons, but that's one of the main reasons why the industry struggles. Because when you have that much money and you're managing that in a large portfolio, you have too many stocks or you have too many bonds, and you can't really be anything different than the index. And usually you're an inefficient index charging too high a fee. And so when you're an inefficient index charging too high a fee, you generally underperform. And that is exactly what you see in the market. That's why, for example, at Aperture, we changed the fee model so that me as the manager, I'm incentivized to control my capacity. Because if I have too much money and I don't perform, I don't get paid. So I have a significant incentive to control my capacity and produce performance, which is what you, the client, want me to do. You don't put me in business to go out and raise all the assets I can raise. You put me in business to perform. But you pay me on a fixed fee. You pay me to go out and raise all the assets I can raise because I make more money if I raise more assets. So it's crazy that you, the client, pay me a fixed fee because it's not in your interest to do that. What's in your interest is to pay me a performance fee. because then I want to get paid if I perform. And that's what you want. So if you structure the industry that way, you will control capacity and you will not be able to manage as much money as managed actively. So the question is, how does the other money get deployed? And the answer is in passive. Mm-hmm. And by the way, it's cheap and it's ubiquitous and it's liquid. Good. That means that it's easy for me to access beta and that I'll create alpha with managers that are more concentrated, and I'm paying them to create the alpha. So I have some confidence that in fact they will do that, because if they don't get paid and they clearly won't be a good manager, won't be in business. And so I'm picking from a pool of managers that are incentivized to do something that is aligned with my objectives. And I may have fewer of them and I may have less money, but if they make alpha spread over my portfolio, that's better than where I am today, because today I just have a bunch of managers that on average don't produce alpha. So I get no alpha. So even if I only have 20 or 30% of my money allocated to concentrated managers that produce alpha, that's way better than I am today. So yes, that's what I think the world looks like, 10 to 15 years from now.
For sure. And it will also kind of resolve the ever-pressing issue of fee compressions.
Yeah. Well, by the way, fee compression is what the industry's response is to the fact that it's not performing. So you have a subpar product that's attempting to maintain its assets and gather more assets by just cutting its fee. But think about that. Again, I'm the buyer. It sounds great that the fee is going lower, but the fee is going lower for an ineffective product. Why does it even matter to me? Why? It doesn't make me feel any better that I'm paying less for a product that I'm not getting what I need for. That doesn't make any sense. You should pay more if you get a product that actually does what you want it to do. In fact, you should be happy to pay as much as you can, because when you're paying as much as you can, you're getting much more in return. If you only pay if you pay 30% of whatever the outperformance is, you get 70%. So if you pay more dollars, you're earning more dollars. That would sound like that'd be a rational construct.
For sure. Moving a little bit towards the regulatory landscape, do you think the regulators are planning on bringing something new to the industry to monitor the COVID-19 situation and the impact of COVID-19 on the industry?
Again, I don't think it's COVID-19. I think what I do think, this is a complex question, but a good one. The main issue in the securities industry throughout the world is the mismatch between the liquidity of the underlying asset and the liquidity demanded by both the client and the lender to the fund. You say, well, what are you talking about, the lender to the fund? Well, not all funds use leverage, but many funds do use leverage. Mm-hmm. And if the leverage is nightly, in other words, every night I mark your collateral to market against the leverage, and if the collateral goes down in value, you have to put up more collateral. If you don't have more collateral, you have to sell it. Then you force the value of the collateral down. And when you force the value of collateral down, then the value of the NAV goes down, then clients redeem, and it's a cycle. Mm-hmm. So COVID-19, like 2008, has again illustrated the negative effects of leverage and the impact that has, meaning leverage has, on the stability of markets around the world. All of the things that the Fed and the ECB have done since the COVID-19 crisis have been to stabilize those markets. They have been to put bids in the credit markets and ultimately in the equity markets, so that market prices are more rational. I think that what the lessons of these crises will be that we need to continue to be vigilant about matching the maturity of the asset with the maturity of the fund or the investment vehicle, and importantly, the maturity of the debt against which the asset is levered. Both things are critical. And regulators around the world have to start thinking about that. It doesn't help us when a bank lends to an investor, meaning the asset manager, against an asset where the asset doesn't have the same liquidity as the liability. If the liability is marked every day and the asset can't be sold immediately, then you're just depressing the value of the asset, asking for more collateral. which depresses the asset value further if you have to sell the collateral. That's not good for the market. And every time we're in one of these crises, those levered vehicles cause that issue. So we have to think about what's the best way to resolve that. The resolution isn't no leverage, but maybe the resolution is, okay, well, you can lever the asset, but the leverage has to have term. So then the leverage doesn't get called every night. And so then you don't have collateral calls that then force the collateral down. There are things that we can do that would make that more effective. That is the impact of this crisis on the financing markets and the liquidity of the markets. I think regulators will feel good about the fact that banks have more capital this time around than they had in 2008. I think, however, investors bore the brunt of the collateral that used to be on the bank balance sheet that now is on their balance sheet, which is getting marked down in value, and they're losing money. And so somebody's always going to accept that risk. And the question we have is, can we build an ecosystem where we minimize that risk in times of crisis? You can't get rid of it. It won't go away. And by the way, we haven't seen the credit risk yet. And so there's a recession going on. There will be credit risk. And we have not actually seen that credit risk come to the fore. What we've seen is liquidity risk. We're solving that liquidity risk, but we are going to have credit risk that is borne by the investor. And when it's levered, it's more dramatic.
Mm-hmm. Mm-hmm. And around credit risk, what recommendations would you give our audience to in their company to make sure that they're coming out of it stronger, not in a lot of debt?
Well, that is the main problem of this crisis. I think what's interesting about this crisis is that companies are experiencing not 10% reductions in sales or 5% reductions in sales, but 50%, 60, 70%, some cases 80, 90%. Hotels, they may have 5% occupancy. Airplanes, nobody's flying. It's not like they're flying, 80% full. They're flying 0 full, or they're not flying at all. Restaurants, there's nobody coming. Testing organizations, medical testing organizations, nobody's going to the doctor. There are no tests that are happening. So for a short period of time, short defined as a few months, you literally have almost no sales. Well, if you think about that, the impact in a year, that's a big percentage decline. If you lose even 1/12 of your sales, that's still 8%. If you lose 2/12, now, you're talking about, 16%. So your sales going down 16%, that's enormous. So what's happening is that your fixed costs are continuing, and somehow you have to finance those fixed costs. The only way to finance that is either raise equity, which I think you will see, by the way. I think companies will come to the equity market to raise equity to fix that hole, or debt, which is what you're currently seeing. But when you add debt to the balance sheet, that's unexpected. That's additional leverage. That's reducing your flexibility. That's deteriorating your credit. All of those things will have an impact. Now, it's a scale of impact. Some companies, the impact is going to be marginal. They're the stronger companies. Some companies are already levered. It's going to be much more significant. And some companies that are very levered, they may not even be able to do it. And that's where you'll see the early defaults. Mm-hmm. And then the question is, how fast do the company's earnings come back? Because now they have a more leveraged structure. And as I just finished talking about leverage, now you have more leverage on company structures. So I think that COVID-19 this crisis is an interesting crisis in as much as it's not a traditional recession where you have a recession, it takes 12 months, 18 months later you come back. This is a very, very fast shock that may not last as long, but you literally are out of revenues for a period of time, and then your expenses continue. The only solution to that is to leverage your company or go out and raise more equity. And it's hard to raise equity when your equity is down 50%. But that may be what happens. So the dilution to the existing investors could actually be much more dramatic. That is what we saw in 2008. In the financial crisis, when banks had to go out and raise equity, they did it at tremendously dilutive levels to the existing shareholders. So there's real risk to the investor today that I'm not sure is being assessed in its full manner at the present.
What would be the positives that the industry will receive from this crisis?
Well, look, all crises end. This one will too. We will be sitting here probably a year from now saying COVID-19 is gone. Mm-hmm. It'll go away as fast as it came. There will be a hole having been left. We're going to learn from that. Investors are going to learn from that. I think those investors in this crisis who manage risk effectively will be more heavily sought after. That was true in '08 too. I'm not sure it's going to be any different in this. The active passive discussion is an interesting one because this is a case where active really has an opportunity to shine. We will see if it does. I know we are, but we're just one small company. But I think at the end of the day, this crisis is going to look like every other crisis I've been through. You will go through it. Markets will decline. Markets will come back, and the world will march on. And some companies will be stronger, and some companies will be weaker, and some companies won't be here. And that's that happens every time. Mm-hmm. I think the key that investors need to remember is if you leverage yourself, that is the biggest risk in a crisis. If you're unlevered and invested, you'll see market decline. You'll see equities decline. Equities will come back. Maybe not all of them will. You'll own bonds. Bonds will go down. Bonds will come back. Some bonds will default. But at the end of the day, we've been through these crises before. We know what these default numbers look like. They're not greater than 10 or 12%. That's in the high yield space. In the investment grade space, they're much less. So we know what this is going to look like. It's just a question of what its duration is and what the drawdown is during that time.
Mm-hmm. Perfect. Thank you very much, Peter, for this lovely chat. Really appreciate it. Thank you for joining.